right, ladies and gentlemen, White Line Realty, what's going on? We have got Garrett and Chris here from Catalyst Funding, right? Catalyst Funding?
Yep.
Got you. These two guys, I met Chris a while back at one of our White Line mixers, which is awesome. I haven't met Garrett in the flesh yet, I don't think. Or were you at the last mixer at the...
I was not, no.
No, you were not. So I haven't met him in the flesh yet, but I'm looking forward to it. He's got one of those new San Antonio numbers, the 726, which is always interesting, which means he ain't puro. You know what I'm saying? He ain't an OG to San Antonio. That's how we dime y'all out. We figured that one out. He ain't got a 210. You're new. But yeah, I'm excited about it, guys. So here, one of the main reasons I want to talk is Chris. And Chris has been really supportive. He's always been to our mixers. He's been doing a great job of talking to you guys. A lot of y'all should recognize him and know who he is. I know you do a lot of work with Chris Negron, which he does. He's one of my favorite agents with White Line. That guy does a lot of great stuff, and he's so helpful with all our agents. So I love you, Chris, if you're watching this. But then, but what I really found interesting about this, and which was the video that I shot the other day for you guys, was about that these guys do both hard money and the traditional financing. So I'm going to get on a soapbox for about 2 minutes here and explain to everybody. I do a lot of BRRRRs. For those of you that don't know, BRRRR is buy, rehab, rent, refinance, repeat. Now, unlike some investors, I don't have $700,000 just sitting on the sidelines. So I do tend to use a lot of hard money when it comes to the buy and rehab and rent part. So during those three phases of it, I tend to do that on hard money. The reason why I do that, guys, I can usually get in for somewhere around 10% down, 10 to 15% down of my purchase price. They tend to finance 100% of the rehab budget, as long as it's less than 75% of the total value. And then, so I get that money in the process, which there's a draw, and we're going to talk about that. I've already been setting those guys up for this one. And then while I'm still in that hard money loan and I'm just making interest only payments, which tend to be a little bit less than my finished financing, that's when I put renters in there. Now, I've gotten in a very bad habit, guys, because I'll put renters in there and they'll be making the payments and I'm cash flowing and life is good. And I forget to refinance out of that hard money loan. So those hard money loans tend to balloon in 12 months, typically 6 to 12 months, depending on where you are. I've seen a few at 2 years. And when they balloon, they want you out of it. Like, you better pay us off 100% of what you owe, which is where that refinance comes in. So I bought a $100,000 house. I borrowed 50 grand to put into it. It only cost me about 10 grand down. I get the money back from the draw process. And then I go to refinance it. That's the part that most people don't think about. They think that once they have this property all set up and ready to go, that banks are just going to be crawling through the windows to come to you to loan you money on that property. And they're not, guys. They just aren't, especially in today's climate. Today's climate is yucky when it comes to lending. It's just, that's the word I'm going to use, yucky. But you have to do it, guys, because otherwise you're going to default on that hard money loan and they can foreclose on you. They can do all that kind of dirty stuff, charge you a bunch of fees. I've had all of it, not foreclosed, but I've had fees charged to me, extension this, whatever fee that. I've had it all, guys, and it sucks because it gets really expensive really quick. They want out of that loan. But these guys have the refinance product on the back end. So if I understand this correctly, and I'm going to have y'all walk me through this, they come out, they appraise the property, they figure out what it's going to look like once they're done. They're able to use that appraisal and your original qualifying information to qualify you on the back end. And that is so brilliant. I've already told these guys, I said, my next one, I'm going through them. I really want to see how this works, and I want to do it firsthand because we were joking earlier, I hate getting loans. It is the worst part about being a financially independent real estate investor guy, because like I was telling them, I just met with my tax lady last week, and last year I made on paper negative $50,000. That's really hard to qualify for a loan for. When you come up and say, hey guys, I lost 50,000 last year, can I borrow $1 million? They're going to say no. So they have things called DSCR, which we're going to get into all this. So first and foremost, sorry, I'm off my soapbox. Let's introduce the two of them here. Let's start with Chris first. For those of y'all that know Chris, do you mind introducing yourself? Tell us a little bit about this, how long you've been doing lending and all that good stuff.
So I've been in lending for about 7 years. Well, first off, my name is Chris Williams. I'm with Catalyst Funding. And I've been in the industry about 7 years. I was previously just in traditional qualified mortgaging, which of course everybody knows it's conventional as well as FHA. But then I found an opportunity here with Catalyst Funding, which they offer hard money lending as well as conventional financing, refinancing, cash outs, blanket loans, buy and holds, or just hard money to flip it. So it's been a it's been a different it's a different what do they call that, a different animal in regards to the qualifications, the assets, just different things like that. But I'm still fresh in the game of buying flips and flipping and that. But I see that they have really really good products that a lot of other hard money lenders don't have and don't do. So
Yeah, absolutely. And I will say this, guys, like I have met Catalyst through the years and they've always intrigued me. I don't know why I haven't used them, so we're about to change that. But Garrett, tell us a little bit about yourself.
Yeah, Garrett Brown. The reason that I don't have that 210 number is I moved here from Arizona. So been in San Antonio for about a little over 2 years now. But I'm the sales manager for San Antonio Catalyst Funding. We currently have 3 LOs over here. And I have about six-ish years in the lending industry. Came from a big bank, Wells Fargo, was an LO there, and then a sales manager, trainer, everything. And the reason I came over to Catalyst is I want to be in real estate investing myself, and I figured the best way to learn was to be on the inside, and here I am.
Got you. What kind of investing are you thinking about getting into?
I want to start doing flips. That was the biggest thing, and then joining here, I found out all about the Burr method. So that's kind of on my list now as well.
Oh yeah, the Burr method's nice. I will say that it's kind of been a little rough this past year with interest rates tripling. It kind of makes that refinance part tricky that we were talking about. But yeah, so tell us a little bit about, so I know Chris knows about White Line. I'll give you the 30,000 foot overview. Is we're basically a brokerage made by investors for investors, right? I almost exclusively work with investors. We do have some agents that do the sign in the yard, traditional sales stuff, but a lot of us are investors at heart, and we do work with a lot of investors. So talk to us a little bit about y'all's hard money loans, the different kind of loans y'all have for that initial purchase. Like I'm buying me my first turd that I got to go fix up. Talk to me about how y'all do that.
Yeah, so one of the most unique things that you'll see, I mean, you mentioned with your previous hard money lenders that you have a loan to cost essentially, right? So you're putting 10, 15% down on the purchase price. We don't have a loan to cost. We lend strictly on the ARV of the property. So, if you find a deal discounted enough, there's a chance you come out of pocket nothing. We just did a deal in Houston right now where the borrower is essentially paying $50 at closing because his purchase price is so low. The rehab is keeping his loan to value under 75%, which is what we lend up to, 75%. He's coming out of pocket nothing. So you can't really do that in any other hard money lender out here right now.
So if we've got the rehab, so I just want to make sure everybody understands what that is, because I know we kind of glance over that. What he's talking about, guys, when he says ARV, he's talking about the after repair value. So when you buy a turd, I got this house, it's falling over, I'm going to flip it, right? The purchase price, which is what he said at the beginning, is how much you're buying it for. But when you're done, that after repair, after you fixed it, what's it worth? And that's all he's looking at, right? So if after I'm done with this turd, it's worth $300,000, let's do easy math here. It's worth $100,000. You're saying you'll lend up to $75,000 pretty much no matter what. Now,
so we have a range.
You can't buy that house for $75,000. You're going to want to buy it for let's say 50, and you got 25,000 in rehab, right? If you've got those two things, that's a total of 75%, which if you're listening to investors, we say that a lot. We say, is it a 75% deal? It's closer to an 80% deal. Oh man, this is a 65% deal. That's what we're talking about, especially when we're talking about flips.
Yeah.
So you'll do 100%. So 100% of the rehab, and then whatever the difference in that is between purchase price, rehab, whatever the difference is, 75% is going to be your down payment. Is that what we're getting at?
Correct. So easy math, right? If the ARV is 100,000, you purchase it for 50, You have 20,000 rehab. We can roll in the closing costs as well if there is. I mean, there's going to be closing costs. But whatever the total comes out to, if it's above 75%, that's what you'll come out of pocket. If it's below 75%, we'll just cap the LTV, and you can basically go to closing with nothing.
Yeah. So on the other side of that, guys, if you got 50,000 and it's a $35,000 rehab, you're going to have to come out of pocket that 10 grand plus
Right.
closing cost, right?
Right.
So to kind of give you an idea. So the next thing is talk to us about how this draw process works. Because a lot of people have questions about how do I, okay, well, I financed the repair, give it to me. Give me my $25,000 so I can fix it. Is that how y'all do it?
So the way that we do it, you'll submit a scope of work. Scope of work can either be extremely detailed, depending on how you want to do it, or it can be just very generalized. Some people will even just request a final draw at the very end. But we do have an inspector go out and look at the work. So let's say you submit a draw on Monday, the inspector will go out there either Monday evening or Tuesday. Once the inspection is completed on Wednesday, we'll have an ACH set up and you'll get your money Thursday or Friday. Now, we don't have, I know you mentioned, Colin, or you have had an issue where someone said, oh, this doesn't look like $5,000 worth of work. We don't judge based on once the scope of work is approved by us in the beginning before we even fund the deal. Whatever you put there for the dollar amount, we just going to go verify that it's completed and then send the funds.
So you have a physical person that goes out and looks at the property.
Correct.
Yeah, I've met some of them that do like FaceTime and different stuff like that to see that you get your things done. But I guess you'll have a physical person that goes out.
We do, yes.
So
how much is that inspection cost?
Sorry, what was that?
How much is that inspection cost?
The draw inspection fee is $150.
And that's pretty standard, guys.
Yeah.
And I don't think Garrett or Chris keep that. I think it goes to whoever drives over there.
Correct.
The next thing I do want to point out, guys, is when you're buying a property in this situation that we're talking about, even if it's a perfect deal. So like Garrett said, if we have $100,000 ARV, I bought it for 50, I'm going to put 25 into it, right? That's exactly 75%. I got to come up with closing costs on that kind of property. It'd be like probably $3,000, right? 3,500.
Yeah.
So I'm going to have to come up with that to close. What most people don't think about, now agents, this is just me giving you the daddy speech, is you have got, like if you have $25,000 in rehab and you're just going to wait till the end to get that draw, you're going to have to front that $25,000 to pay the employees. Like if it's $25,000 in a new roof and new drywall and new all this and new that, Home Depot's not going to let you leave with shingles because Garrett's going to pay you in a week. You've got to pay Home Depot right then for your shingles and drywall and all your crap. You're probably going to have to pay your workers the second they're done. If they're like every other contractor on the planet, they want their paycheck like 3 seconds after they finish. So guys, don't forget to work into your equations when you're thinking about these deals. Like I'm not saying you need the full 25, but you're probably going to need about 10 grand, right? Get your stuff, get the guys started, let them finish one of the projects, call your draw guy in, get the 10 grand back, right? And then you redeploy that 10 grand for the next part. So you're going to need a little extra cash on the side, guys. So don't forget that as we're going forward. I mean, no matter how great a lender is, they still are not going to front you money on work you haven't done. I've never met a lender that'll do that. Even like if you do a 203K loan, I mean, even FHA is going to make you work your way through all this stuff, which is really frustrating. So just make sure you're thinking about that. So tell me a little bit about the process. So I find a house, I identify it. What do I do to Catalyst to see if I qualify? What are my steps coming out the gate? Like call Chris. Hey, Chris, I found a house. Chris, what do I do next after that?
So what we'll do is we'll send you a link in order for you to fill out the hard money application. But we'll also send you out another link for the end loan as well. What we request that you do is go ahead and fill out both applications. That way, by the time, let's just say you do get approved for the hard money, by the time those repairs are done, your end loan is ready to be funded. But what would happen is you would fill out those applications. We can actually give you a pre-qualification off of a soft pool. Because let's just say you don't find a property, yet or something, and you want to be pre-approved, our hard money pre-approvals last for 6 months. Of course, traditional, let's just say you're going to do a conventional, last 120 days. So, but the good thing is, again, is that we actually can do both of these loans with one credit pool. So you would fill out those applications. I would go over the numbers, and then what I would do is get back to you and give you the breakdown of what those numbers look like. And if you feel it's still a good deal with the numbers that I give you, that's a decision that you're able to make.
So talk to me about, so we're doing a soft pull to get pre-approved. I really like that idea because I think a lot of people try to find the house first, and that could not be more wrong. You should always be looking for houses, but the first thing you need to do is make sure you got somebody that'll give you money. It's like dog chasing cars. Like, what do you do once you catch one, right? If you're not prepared, you're really going to mess up. So I really like the fact that you'll allow us to at least get the majority of it done, right? Because guys, any loan, it doesn't matter what loan, they're going to qualify you and they're going to qualify the house. It doesn't matter if it's an FHA loan, a VA loan, a hard money loan, it doesn't matter. They want to qualify both of those things. So what he's saying is, let's get you out of the way, right? And that way we just have the house when we see it. And then I'm pretty sure y'all could probably close within probably 10 days on a hard money loan, 7 if the buyer's already pre-approved.
Yeah.
7. That's quick, guys. That's really, really quick. Second question, when you say you're doing a soft pull to pre-approve me, what are you looking for? Are you looking at how much money I make? Are you looking at what are you looking at?
We're looking at the credit, basically, how many open accounts you have. We're looking at, the utilization of the credit that you currently have. Let's just say it's credit cards. That's what we're looking at. Pretty much just to make sure that, you haven't defaulted anywhere. Was it in the past, Garrett, what would you say the past
2 years? So, I mean, the biggest thing we'll look at, right? We want to look at a credit score. Hard money, we want a 660 or above. The other thing, major thing with qualifying for hard money is just assets. So those are really the 2 things you need for the hard money side, is liquid assets and then credit score above 660. Any like foreclosures, things like that are obviously going to affect that, but those are the 2 major things we're looking at. And then available credit, we look at as like maybe you're on the cusp of qualifying, right? But you have $100 grand in available credit on your credit cards. We might use that as a something on the side to maybe approve you if you were technically approved, because you have available access.
Right. So guys, the reason why they're doing that, and then the other thing, wait, correct me if I'm wrong before I explain that, you're also going to look at not only our assets, but also our experience, right?
Right. We don't have an experience requirement. So, I mean, we deal with a lot of first-time investors. Now, if you have experience, that's obviously going to help you, especially for certain deals. Maybe if it's a little further out of, San Antonio or other cities. If you're more experienced investors, we're more likely to you're more likely to have leeway there.
Yeah. So, guys, ladies and gentlemen, listen to this call. That is huge. I can't tell you how many people have tried to get into real estate investing that I got to go talk to a hard money guy and kind of vouch for them. Not that I'm co-signing or anything like that, but like, no, I've been working with them. They know what they're doing. Don't worry. I'll take a look at the project, whatever it is, just to make the hard money guy that I have a relationship with feel a little bit better because they have 0 experience. They're telling us you don't need experience. And that's guys, there's so many hard money guys that won't lend to you unless you have 3 deals under your belt. And I hate that because it's that same thing at the job interviews, right? It's like, well, you need 20 years experience. I'm like, I'm not supposed to get 20 years experience if nobody will give me a damn job, right? And so it's a little frustrating because it's a chicken or the egg thing. But if they'll lend forward, now, guys, I will say this. Garrett might be a little, I'm going to press him on this one. Typically, when that happens, if you're first time with little credit, you tend to get higher interest rates, maybe higher origination points. Is that correct on those 2?
No. So we have like basically an algorithm that will qualify you. We have tiers that is how you're going to qualify on points, interest rate, things like that. The biggest players in that is credit score and assets. So if you've done no deals but you have a ton of money, we're going to qualify you. Now, people with little money, that's kind of where it gets riskier for us, because if something happens, maybe something goes wrong with a rehab, ends up being more expensive. We want to know that you have the money to keep that pushing forward so you don't go into foreclosure.
Right. And that's the important thing, guys. Like I have to remind myself, I was telling them before we started recording and all that about how much I hate qualifying for lending. I hate it. It is the most, I hate doing it. I am extremely organized. I love it. I've got a VA that keeps all my stuff in folders and all this stuff, but they want to know a lot of different things. And it's a little frustrating for me. I just don't like having to constantly send things, but it's part of the game, guys, unfortunately. But the nice thing is if you got to remember why they're asking all this stuff. They're asking you because they don't want that house either. They don't mind lending you the money. They want to lend you the money. They want to make some money off interest. And they want this whole deal to go super smooth. They do not want the house. If you can't wipe your own butt and pay these guys their money, they're going to come and foreclose on you and take the house away from you, right? Now, Garrett's got a whole new problem. I got this halfway finished house that I got to dump somewhere. And you know what I mean? And it's a whole new problem for him that I know that they've got a whole department, I'm sure, that just moves that kind of crap. Because it does happen. It happens more often than I would think it would happen. It's weird because it never happens to the new guys. I always feel like it happens to those super experienced guys that are always on talking trash and have them big Facebook following or whatever. And then they default on 3 in a row. And I'm like, where are y'all at? But so, yeah, guys, so that's the first one. So when it comes to charges, what kind of interest rates are y'all charging right now on hard money?
Yeah, so the terms, the rates are going to range anywhere from 9.99 to 13.49. 9.9 is an introductory rate, so it's for 60 days. It's for the more well-qualified people. And that's the reason we do that is, the people that are buying and holding, which is our primary target, the goal is to be in and out of property as quickly as possible. So those first 60 days, you get that introductory rate at 9.99, but it varies.
Kind of hurt your
up to
butt.
13.49, yeah.
So guys, I know 13.49 sounds really, really high. It's not for hard money. Actually, I'm surprised it's not higher right now, considering what the base rates are, considering that interest rates have jumped up so much. Usually these guys like to have a lot bigger spread. They want to make 6, 7, 8% between that spread. And right now it sounds like y'all are making maybe 3, 4, 5, right? Something like that.
It's not much.
Yeah, it's not as much, right? So there's a lot less cooking, but they also know that we're not going to borrow unless they keep that down as low as we can. So it is probably going to make them a little bit stricter on what they're looking for, right? Because their numbers are thinner and they really don't want to have a problem with thin numbers, just like anybody else. So I want to point out one more thing that Garrett said that I thought was really intelligent that most kind of miss. His goal is to get people to hold properties. And ladies and gentlemen, that should be your goal too. A lot of people see these wholesalers and these flippers on TV and they're like, man, I'm going to get into real estate investing. That looks like so much fun. It is, it can be, but guys, it becomes a job. If you wholesale a property and make $20,000, as soon as you spend that 20 grand on fancy cars and Instagram posts or whatever you're doing, he's laughing because they know the people I'm talking about. Once you spend that 20 grand, you're out of money and you got to go do another wholesale. Guys, the game is, and that's why I do so much burrs, is to hold as much as you possibly can. And if you do a burr perfectly, you should have zero money out of your pocket and you just have a new house. And I will say this, and I've said it 100 times, guys, once you do a burr, you're not cash flowing $1,000 a month, and I'm that much closer to retiring. You're usually cash flowing $100 to $300 a month, which is very thin, especially in today's market. That's what you're looking for. But guys, it's an asset that I own that has 25% equity in it. It's going to make more money. They're paying my bills down, all that good stuff. And you don't have to hold long-term rentals. You could do land leases. There's a million options, but you want to try and hold, guys. And that's where it's going to take me. See, this is what we call a segue. Moving into the next thing is onto your hold side. Now, most people here have talked ad nauseum about qualifying for a house. They've worked through it, so I don't want to go through all the FHA steps and all of that. If you want to, guys, we can do that later. But I want to talk more about that investor side loan, the one that we hear so much about, the DSCR loan.
Yep.
So I know y'all do DSCR loans. So talk, well, first of all, what does DSCR stand for?
Yeah, debt service cover ratio. Essentially, what we're looking at is the money you're making on the rent is covering the mortgage payment and all the expenses.
Gotcha. And they usually do that, guys, on a percentage. They want to see a certain percentage. What percentage do y'all want to see? 1 point?
I mean, technically, we go as low as 0.75, but ideally, above 1.
Yeah. Most of them like to see 1.25 guys, which is really hard to do right now. And just in case you're wondering, that number is what the mortgage payment is versus what you're charging for rent. And when I say mortgage, I mean principal, interest, taxes, and insurance, all 4 of those. So let's say that's $1,000 a month, right?
And
just
HOA.
for easy math. Huh? And
Yep.
HOA, yeah. Sorry, anything that'll get you kicked out of the house, basically,
Yeah.
right? Anything that'll get you kicked out of the house. If you don't make one of those payments and you leave, that's what they're going to consider. So, and HOA, if you want to throw that in there, but most rentals aren't in HOAs.
True.
So we got those 5. Let's say for easy math, it's $1,000. If you're charging $1,000 a month in rent, that is a 1-to-1 ratio. So that is a 1.0. And if you're charging $1,250, you're at 1.25. That right there, guys, is where once you get into that 1.25 and above, you're going to start getting really good interest rates from these guys, because they know you're going to have enough money on the side in case something breaks or goes wrong or anything like that. If your PITI is at $750 or $1,000 and you're charging $750 a month in rent, that's a 0.75. That's what he's talking about on that end, guys. So we're 0.75.
I got a question on that.
Yeah.
How is the rent rates determined? Do you have to have a lease in hand, or is it an appraisal, or how do you guys determine the rent rate?
Yeah, so we
Great
use the
question.
lower of the two, either whatever they're leased out for, or the appraisal, what the rent appraisals come back for. We use the lower of the two. And the reason we do that is, there's people that'll be like, oh, we're renting this house out for $2,500 when, everything in that area is like $1,600. So, but we'll use the lower of the two.
Okay.
Right. Yeah. The lower one of the two. So guys, if you look on your appraisal, if you get a standard appraisal form, it's typically, I want to say it's the 3rd page, and it's in a little bitty box about 3/4 of the way down that 3rd page. And it says market rents or something in there. And it's not very big, guys. So if you go look at your appraisals, you should see it. I don't have one readily handy, or I'd pull it up and show you. But that's where that goes, guys. So that's why you all know this. When you're going to sell a house, you can't just think of what the number is. You got to be able to prove it, because eventually an appraiser is going to come in and you're going to have to fight with them. You're going to have to prove what you thought was correct. And just because your primo will pay you more in rent than everybody else doesn't mean they're going to buy it. I mean, yeah, you know exactly what I'm talking about. Like how many times have Garrett, have you seen somebody turn in a lease for $2,500, but you pull the bank records and you see they're only getting $1,500 a month in rent? Have you seen something like that?
Yes, I have.
Guys,
and that's why that's in place.
Exactly. And this is why I hate doing loans, because all these stupid procedures are because people trying to cheat the system. Exactly. Guys, don't be lazy. They're going to find it. Don't bullshit. And the second thing, it's a little thing called mortgage fraud, which is a federal crime. You don't want to bullshit people over these things. Because if you get caught, if they turn you in, that's a big no-no. Especially if they catch you after you've qualified the loan, then that's a fun one. Some people go down hard on that one. So that's how the DSCR works. So if we're on the 0.75 end of this thing, how much of that last 1/4% do I need to personally guarantee, or am I carrying the whole thing? Or can my portfolio do it, or do I have to personally guarantee it?
So if we're doing 0.75, your LTV is going to be pretty low. It's going to be like 65%. That's the only way that we'll do it. If we're above 1, we go all the way up to 80% right now on DSCR.
Got you. So do y'all hear that? So what he's saying, there's a lot of numbers, but he's missing it. So if you're at 0.8 DSCR, right? Would you say 0.8? You get 80% of the loan?
I'm sorry. No, if you're above 1%, we'll lend all the way up to 80% LTV on the DSCR loan. Okay, so that's huge right there, guys. So if your rent matches your PITI, they'll lend up to 80%. Back to that original house, we have a $100,000 value, right? We bought it for 50, put 25 into it. That's 75%, but I had that closing cost in there. If I can get that rent at a 1-to-1 ratio or better, then I'm going to get 80% back. So I should get all of my money, including that closing cost, back. I should. I mean, all things perfect in that world. So, and that's the secret sauce of a bird, guys.
that is the sexy part of a BRRRR is I go out and I buy this house, and next thing you know, I have all my money back. I'm exactly where I started, but all of a sudden I own this asset. And that's the game right there when it comes through that. Do y'all offer conventional loans? Let's say I like one of my business partners, he makes $130,000 a month. Okay. If I go through with that loan, can I personally guarantee and get on some conventional program through you guys?
We wouldn't be able to do it that way, no. But so the way, are you saying like you get on with him on a conventional?
No, we have the LLC. The house is held in the LLC. We don't want a DSCR.
Gotcha.
We want a conventional product instead. Let us guarantee the property. Is that something y'all offer as well?
No, not on the conventional side.
Not on the conventional side. Do y'all do any lending for traditional home buyers, like for our agents that do a lot more of the sign in the yard agency stuff?
We do, yes. Yeah.
Like the FHAs, VAs, all that good stuff?
Yeah, so we don't personally do them. We have a referral. They're within our company. It's just a different section, essentially. We refer them over and they handle all primary residence stuff. Anything investment, second home, we handle. But primary residence, we refer that over.
Got you. So stick on the investment side. And so y'all are functioning as mortgage bankers, right?
Right.
So y'all got a couple $100 million sitting around that you're trying to find homes for.
Yeah. Well, me and Chris don't, but yeah, we do.
Not yet. Just keep writing them loans. Keep writing those loans. All right. Well, does anybody have what are your DSCR rates at right now?
Right now,
I know it's going to vary.
The starting rate right now is 8%. And then obviously there's factors on top of that, your FICO score, the LTV, you're taking cash out, things like that can affect the rate. So it can go up from there.
Gotcha.
But best case scenario would be 8% flat.
Gotcha. And on the high end, I guess we're getting close to 10 probably.
I haven't seen one over, when we get to 10s, it's usually a multifamily.
Yeah.
But single family, I don't think I've seen anyone get above 9 recently.
Okay. Not too bad. So guys, the reason why I'm asking that question, and if you've noticed, if you are one of those realtors that does a lot of sign in the yard agency stuff, you're going to notice here that it's like, man, that seems a little bit higher, right? I got some guys that are getting 6.5%, 7.5%. Why am I paying 8 to 9? Well, guys, you don't live there. The banks know that you're going to be like if you had a choice between your primary house and your rental house, which one are you going to let fall? Right? You're going to let that rental fall, so you always have somewhere to live. They want to make sure that you're covered, right? That they make some money in the meantime. That way they don't end up getting stuck with a house, right? They get to make some money in the meantime, guys. Unfortunately, it doesn't matter if you're going to buy if you're a multi-bajillionaire and you go to buy a beach house, you're paying 8 or 9% right now because you don't live there. It's just the way it is, guys. So it's not like they're trying to really get one over on you. It's just those are the numbers. And if you don't like it, I guess I don't know, write your congressman. So it's the Fed, man. It's not them, right? They can't lend lower than what they are. They just can't. A lot of people get mad about that. Oh, I'm gonna go shop. You can shop all you want. You might find somebody who's 1/10 of a point cheaper, but that's about what it is right now, guys. It's not really. I wouldn't say it's anything super special that I've never heard of, and I wouldn't say it's gouging. It's just kind of what it is. Oh, also, I wanted to point something out just for the green people, just for the rookies. When you're making a hard money loan, when you get that first one, okay, they call it hard money because the interest rates tend to be a lot higher, right? It's easier to get into, but they tend to be a little bit more expensive. But those tend to be interest-only loans, and I'm assuming y'all's are, correct, Garrett?
Correct, yes.
So you're only making interest payments on that. I'm going to make sure everybody understands that when you're only making interest payments, if I take out a $75,000 loan with Chris and I pay him $750 a month, because I'm at 12%, right? So 12% is 1% a month. So 1% of loan, $750 a month, right? That's what I'm paying him. My loan balance never goes down. It will be $75,000 the entirety of the loan. The second thing, guys, is we're not making tax payments or insurance payments. So you need to make sure you're working that in at the front. Garrett, how much insurance do y'all require people to own? Is it 6 months or a year?
A year.
It's a year. So part of your closing costs, folks, is going to be 1 year's of insurance ahead of time. If you need an insurance guy, I got somebody, but find an insurance guy so you know that number when you're running them. Second thing is you're going to have to pay your taxes outside of this. So one of your other closing costs will be the taxes from the day you buy it through the end of the year. Okay. Now, most people don't realize is if you close at the beginning of the year or something like that, and then you go to the end of the year, and I've gotten a 2-year loan before because I had this huge project, right? And it took me 18 months or something like that to finish it.
Oh, geez.
Yeah, it was terrible. It was a fourplex. It was the whole thing. Anyhow, guys, what I forgot about is when you're making a standard mortgage payment, part of that mortgage payment goes for your taxes and insurance, right? That's the PITI, taxes and insurance. When you're making interest only, you don't. So here it comes. I got through the first year, which I already paid the taxes for, and the second year goes by, and all of a sudden I got a tax bill. And I have to pay that. It's not going out of that. Or I can refinance it and hopefully tie that into the refinance. So make sure you're thinking through where all these payments hit. And that's why I like talking to Garrett, because they're just sitting here nodding at me. Yes, that's something that you have to think about. And they will help you walk through it, because this is what they do. They are hard money and DSCR people. They want to get both of those loans, which I think is brilliant, because now they're getting paid twice as loan officers, right? They don't get anything until you close. And they want to close 2 loans per person, which I think is brilliant. Do you charge origination points both times?
Yeah, so the origination points with the hard money are going to range anywhere from 2 to 3.99, so 4 essentially. And then on the other side, if you do DSCR, there are points as well. It's 2 to 3. And conventional, I mean, it just depends on where the rates are at. You can buy the rate down. I mean, right now you're probably going to be paying points, but when the market was good, people weren't.
What differentiates the 2 to 4 points on the hard money side?
So the biggest thing is if we can pre-qualify you on basically a exit strategy. Let's say you're even trying to flip, right? You want to flip this property, but we can pre-qualify you on either a conventional refi out or DSCR. We'll qualify you on one of our special entry programs, just because we know, if the market turns, you have an exit strategy. And so on those ones, you'll get charged the lower points.
Gotcha. And then is there anything that decides the 2 to 3% on the DSCR side?
Not necessarily. That's more of relationship.
Gotcha. Do more loans, pay less money.
Right.
All right. Which one of my agents wants to tell me the difference between a point and an interest rate? A point and a percent. Anybody want to tell me the difference between those two? Ooh,
the point is paid up and the percentage is amortized.
Say that one more time.
The point is paid up front and the percentage is amortized.
Pretty much, yeah. That's about it. I don't know who said that, but that's about the right answer, guys. A point is a percentage point, right? But it's a one-time charge that they charge you at the beginning. So these are origination points that we're talking about. For him to originate the loan, for him to do the job, to talk to you on the phone, to collect your paperwork, to put it all together, to send it to the underwriters, to fight the battles, they're going to charge you between 2 and 4 points up front. Is the point on the loan amount or the ARV?
On the loan amount.
So in our example of a 50 purchase at 75, we're going to finance that whole $75,000. A point would be $750 that I'm going to pay at closing. 2 points is $1,500, so on and so forth. The interest rate percentage is the percentage that's applied to the balance the entire time. A point is just applied one time, and it's typically at the beginning. So that's kind of the difference on those two right there. So now we know what the points are, 2 to 4, and you're going to pay somewhere around 10 to 13.5%.
Mm-hmm.
And then on the backside, you're paying 2 to 3 points to do it again, and 8 to 9%. But the nice thing, guys, I know it's like, oh, I got to pay those points. Yes, everybody pays those points. Can you beat people up on points? Yes, you can. You're not going to do it on your first deal with somebody. If you're on your 10th deal with somebody and you're like, dude, I just want to pay 2 points this time, not 3, you might be able to talk them into it. And it also depends on how difficult you are to work with. I will say that as well. Now, I will also say this: it is not Chris and Garrett's decision. It is decision by somebody you'll probably never meet. But if you want Chris or Garrett to go to bat for you, take care of your shit. Be nice to them, you know, all that kind of stuff, and say, hey, man, this is our third deal. Is there any way I can get like a half a point deduction on that point, you know, on something, right? And you can work them. I'm just telling you that. I know Chris and Garrett probably don't like to hear that because I'm cutting into their paycheck, but you can't. That's the one thing you can work them on. But I'm telling you, you're not going to go, can I pay, you know, half a point? That's never going to happen, guys, because it is a lot of work.
What do you
A
get?
lot of work these guys have got to do. So you want to make sure that they're rewarded. You don't want to. You got to make sure that balance is there, right? If you're easy to work with and you're well qualified, you might be able to talk to them.
Yep.
What else? Sorry, I probably shouldn't have told you that secret, but
No, it's good.
yeah, there's certain guys. But I will say this: one of the nice things is they're not charging us for a second appraisal.
No.
So that's saving you. I don't know. What are y'all charging appraisal right now? $850.
So for the bridge appraisal that we do, which is what I think you're referring to, that's $850 right now.
$850.
And the reason that's so unique to us and no other hard money lender that I know does it is, you know, we'll take the initial appraisal up front, the subject to appraisal, which is essentially, you know, we're looking at what you're planning to do to the property, scope of work, you know,
Yeah.
what it's going to look like.
Hold on. Real quick, Garrett, sorry, I'm going to interrupt. Guys, he said the subject to appraisal. Do not confuse that with subject to the existing financing investment strategy. He's saying that appraisal, they're going to appraise it as it stands, all jacked up, and then they're going to look at your scope of work, and subject to all of that work being completed is your new value. So
Right.
That's what he's saying there. Sorry, we just did a couple things on sub twos, and I want to make sure they didn't get sideways on that.
Probably good side note. But we will basically honor that initial appraisal at the end when it's all finished and you're ready to get out of it and refi. And the reason that's important, especially in this market, is, you know, sometimes you get one appraisal that goes out initially, and then the other appraiser that goes out 4 or 5 months from there, you know, when it's all said and done, and maybe comps have changed, maybe things have gone down. And the whole deal you did up front was based on an ARV of, you know, 200,000. So the money you came out of pocket was based on 200,000. If it comes back lower on the backside at 180, 190, that means you're coming out of pocket more if you want to keep it. So our bridge appraisal basically negates that from happening. We just go and verify that everything that you said was going to be done is done, put a stamp of approval on it, and that's the appraisal we use.
Gotcha. And you know, I want to give one more piece of advice out there. I was ranting, I guess, about a previous hard money lender that I used that it got ugly between us. And the reason why it got ugly was because the loan officer was not looking at the deal in its entirety. He was plugging in numbers based off of guesses. So when it came down to closing time, the numbers were drastically different. And I could have prevented that, guys, by taking the minute and all that information that we have just shared with you and actually doing the math myself. Now, I was lazy and I never really did it, but guys, it's not a secret. Everything that they do is not a secret. It's all very open. Now, the reason what I should have done is double check that guy's math when he was sending me things. I never did. I just assumed he was right. But guys, you can double check the math. And especially if it's your first couple deals, you should really be double checking your math. Double checking their math. They make mistakes too. I've never met anybody that did something that seemed really nefarious or like they're trying to screw you, because you got to remember, all these guys report to they report to the Consumer Financial Protection Bureau. That is a national level. We just report to a state level. So they can get in a lot more trouble than we can. So they're really going to watch it, but nobody's going to watch your money as well as you watch it. So make sure you have a full understanding of what it takes to get into these loans and what it takes to get out of them. What it takes to get out of them, guys. That's why I really like this loan product, this bridge thing, guys, because you're going to know the whole thing start to finish. All right. Well, I think I've asked all my stupid questions. Anybody have any questions that they want to ask of these two gentlemen? All right. Well, then how do we get a hold of you? How do we apply?
You get a hold of Chris, and he can handle all your stuff there.
Yeah, I'll definitely send you my information. Also, I wanted to bring up that we are having a mixer coming up
Yeah.
on October 25th. I'll go ahead and send you that email, Colin. But there's going to be, if you RSVP, you'll get a couple of free drinks as well as, I believe we're going to have some food out there too as well, correct?
Yeah.
And so, and there's going to be other investors out there as well. So if you guys want to come out and network and, eat some food and drink, have a couple of drinks, definitely come on out.
Where's it at?
It's going to be at Chicken and Pickle.
Oh,
Con hielo, ¿verdad?
I don't know who that is. I thought I muted everybody. Oh, it's Edmundo's cell. I got you. Sorry, go ahead.
Yeah, but
It's a
that'll be
chicken and pickle.
October
Are we
25th.
playing some pickleball?
We can. It'll be at night, so it won't be as hot. Finally.
Yeah, it'll be nice. So I'm sure we can manage it. I don't know if I want to hurt
Dude,
myself.
if you need me to bring the thunder, let me know.
And I believe you. I believe you. Colin used to be a quarterback, correct, in college?
Not in college. I played semi-pro.
Okay, there you go.
I got asked to play in. I went to Texas Lutheran University, and they asked me to play in college. But my freshman year is when the college football program came back. It was defunct for like 30 years. So that was the first year, and they weren't allowed to offer any scholarships for the first 5 years. And I was like, "You want me to come play football?" No, I'm not playing it for free. So I drink a lot of beer instead. And when I graduated, I met a guy named John, and he's like, "Did you ever play football?" I'm like, "Yeah." He's like, "Come try out." And I was like, "Okay." And one thing led to another. I was the starting quarterback for a semi-pro football team for 2 years.
So I guess what I'm trying to say is that we definitely don't want to play in pickleball. We know you're an athlete.
Well, I'm also 42, so there's a lot of things that pop and creak, and there's a lot more movement in this section than there used to be. So yeah, we're working on it. All right, well, cool, man, guys. I will send out this recording, and I'll also send out the invitation with the RSVP when you get that to me, Chris, and Chris's contact information. Guys, and I will say this, and I probably shouldn't speak on Chris's behalf, but I'm going to do it anyways. Chris is incredibly nice and generous for this time. So if you have a question about this, you can call Chris. I don't think he'd mind. Chris, am I right on that?
Yeah, absolutely. I mean, you guys have any questions in regards to, the hard money, the end loans, as well as any traditional loans, I'll definitely be happy to assist you and answer any questions you have. I mean, even if you don't have a buyer and you have questions about, loan products or anything like that, give me a call.
Yeah, run some guys. He is genuinely a kind and gentle person. A lot of hard money guys, I know what you're thinking. They kind of get that salesy vibe, that you know what I mean, like they're just pushing you into something, and I don't get that vibe at all from Chris. So if y'all do have a question or just need further understanding, I definitely would reach out to him. I think he's a great resource. And Garrett, I do appreciate your time. I appreciate you coming all the way from Arizona. Hopefully it wasn't you that brought the summer's heat, but
all right.
My sister lives in Scottsdale. My sister lives in Scottsdale, and she's like, "It was 113 today." So I was like, "It was a 111 here." Honestly, shut up.
Yeah,
our humidity was higher. Knock it off. So, all right, guys. Well, I appreciate your time. Thank you so much for making it out here. And I will definitely. I think. What time is the thing on the 25th? I was just looking at my calendar.
Let me look here.
7 to 10.
7 to 10 o'clock. Yep, 7 p.m. to 10 p.m.
Dude, I'm in.
All right,
just
perfect.
put me down.
I'm going to send you the email right now. And then all you got to do is RSVP. And then, if you can, also, if you send it out to your reps and invite them, I mean, the more the better.
Yeah, yeah, for sure. Yeah, coming on Lunch and Learns, but you know what? You offer free booze. I bet you we get a bunch of them out there.
Oh yeah, that's the ticket right there. The free drink ticket.
Especially for those of y'all that live on the Northwest side. All right, it is in my calendar. All right, gentlemen, thank you so much. I really do appreciate y'all.
Yes, sir.
Y'all have a great rest of the Wednesday.
Thank you, Colin.
Thanks, Colin.
Appreciate you guys. Bye-bye.
All right.